Hello and welcome to session 2 of the pullback course. Today we're going to be, and this might be a little bit of a departure from one of the earlier outlines you saw of the material. We're going to talk about trends and then look at actually some of the variations pullback patterns take. The second part of that was not something that was in the original outline, but I'll tell you this, all we have done is we maybe kind of move some things around to different days. So everything that was on that outline we will cover, and there's going to be some new stuff added. So that's a little bit of what we're looking at today. Also, one of the things that I'm going to do as we go through the course here, I'm not going to do a lot of explicit review from the previous day because, as I said, we're going to be circling around some of these concepts and seeing things over and over. But I would just encourage you, particularly if this way of looking at patterns and thinking about markets is new, I think it's worth your time is new to you. I think it's worth your time to go back and make sure you watch each session. It's be a good review to watch the previous session before each one. And if you're watching them on a replay, of course, you have lots of ways to do it. So here's what we're going to do today. We are going to look at trends. We're going to talk especially about how trends begin and how trends end. The middle part of trend, the easy part of trend, is easy. And if you were able to identify with any degree of reliability, if you had some like magic crystal ball and you, as opposed to not magic crystal ball, and you knew that a market would continue to trend, it would be extremely easy to trade. So what we really need to focus on as traders from a practical perspective is look, what do we see that shows us that a trend might be beginning to break down? For instance, we're also going to look at specifically how, as a trend is moving and making these pullbacks, what do those pullback patterns look like? And we're going to look at some current examples from the market as of yesterday's close. So before we start, let's talk about trends. So there is actually a little bit of a debate. There are some people who I think are crazy people who will tell you that markets don't trend. And how could you even have a debate between people who say markets don't trend and markets trend? It seems like such a basic thing. And the reason is the answer is right here, that it depends on how we define trend. And it is certainly possible to massage the numbers and to use tools to look at market data to come out of that and say, hey, there's not even such a thing as trend. So one thing that used to confuse me a lot when I was learning to trade and reading books, people would talk about, let's just take trend here, but many aspects of markets. And I would say, well, like, what exactly are you talking about? How do I measure this thing? A very practical question here, and we'll look at charts a lot today, but how do you know if a market is trending or not? How exactly do you define that? And the reality is that whether you know it or not, you're using some kind of tool to answer the question of is a market trending or not. Common tools are right here, trend lines. One of the most effective, I think, is to use a pattern of, so you're looking where a market's making, holding higher lows and higher highs, but even that is subject to some confusion, and this is a useful framework, but you have to understand how to apply it. A lot of people use moving average crosses, but there again, the way this would work is you have a shorter term moving average, which is going to stick to price much more closely, and a longer term moving average. What numbers are you using? Like if you use a 3 and 10 period moving average, you're going to get a different number than if you use a 3 and even 11, but certainly a 3 and 50, or if you use a 10 and 50. So 10 would be your fast there. You're going to see that in any chart, you're going to be able to make any specific bar by some definition say something else. And so all of this is, I would not say, this word here was pretty carefully chosen. It's not that it's subjective. It's not that it's just your opinion, but it certainly is, subject to some interpretation. The other things people use, one of the tools that I have found myself using more and more over the years, is a slope of regression lines. And that sounds complicated, but it's not, and it's especially not hard to do with software. Basically, you have closes or you can use, and for those of you who are more quantitatively inclined, just to kind of talk about this a minute, with a bar, you have three significant data points, at least: the high, the low, and the close. You could throw the open in there, but practically speaking, we don't. And a lot of technical tools are calculated off of the average of that high and low and close. The problem with just taking closes is and you will see this in a moment when we talk about volatility, you're blind to the range of the bars. And a lot of academic measures of volatility, they don't know if bars are giant or small because they're just looking from close to close. So all you do is, whether you're using the closes or that average of the high and the low, add the close in there, double weight the close, whatever you want to do, and then you just look at the slope of that line. Yeah, but still you have to have a cutoff. If you're just just looking at my hands here, it's just very imprecise. If you have a line that could slope, and it's going to slope in different ways, but at what point is it trending here? Is it trending here? You still have to have some number that says this is the cutoff where it's actually trending. And also realize that anytime we say a market is trending, that's backward looking, and it doesn't tell us necessarily what's going to happen in the beginning. And just to make this real, look at this chart of the 10-year Treasury notes now. Is this market trending? Well, yeah, obviously, right? So and one of the useful, by the way, I'm not criticizing this at all, one of the useful definitions of trend is, you can see the chart starts in the upper left-hand corner and goes to the lower right-hand corner. So prices in this chart have clearly followed this path. Now, why is that not a perfect answer? For one thing, it depends on, if I expand, and anybody using software, we know this now. We have to be careful, because a lot of the very intelligent things that were written earlier in those old technical analysis books, they were not able to rescale charts as easily as we were. So they might have thought there was more significance there, but depending how much data I put on this chart, I can make it look very different. And in this particular case, yeah, we are in a downtrend, but where does the downtrend start? Does it start here? Does it start here? Are we downtrending here? Market went up for a little bit, right? Are we downtrending here? Are we downtrending here, or are we flat? So these are the kinds of questions that two people could look at a chart and could have very different opinions of what's going on. Are we downtrending here because we've been going up for like a month? So is that something that happens in downtrends? Does the market go up in downtrends? That's the challenge of these definitions. But if we're looking here and we want to understand in very broad strokes, how does the market get from a higher price to a lower price, or vice versa, a lower price to a higher price? And it's pretty clear for anybody who spends 3 minutes looking at charts. If you've never seen a chart, it's pretty clear that these lines I've drawn over here to the right of the screen, that's not the way it works, right? You don't just see a market go in a straight line from one price to another. That's not reality. Reality is something like this. This is a useful way to think about the market. And one of the things also that I'm not going to do in this course is I'm not going to coddle you. I'm not going to give you like the 101 example of many things. You have a 101 example here. But the way when you write a book, what you do is you show people very idealized examples of the patterns, and the patterns the market makes, and we might even use a lot of line diagrams like this just to show very simply. So like if I want to talk about a trend, maybe maybe I would show you a diagram like that. And then maybe I'd show you how it can switch into an uptrend. And so you have this very idealized structure that in the sense of like the Platonic ideal of a trend. But then when you go look at a chart, I just flip to the next chart. Right? Like how does this actually work? So what I'm doing here in this course deliberately is I'm taking you straight to that where you're seeing the real market patterns, and then we'll start to tease out the truth, with the exception here. So this is what this shows is markets, generally speaking, will make a move in one direction, and then we'll have a move against that and a move in the same direction. We talked about why that might be in the previous session quite extensively. We talked about their psychology here. One of the other things that you need to understand is that this pattern is fractal-like. People like to say that markets are fractal. So what we mean when we say something is fractal is that if you, a very imprecise definition here, and if you want to know more about it, Mandelbrot writes about this in that book, The Misbehavior of Markets, is a book I would strongly recommend. And he was one of the pioneers of applying chaos theory to financial markets. You might remember, it's been a long time, but I think he made a splash back in the 90s, maybe, with this idea that prices could be affected by butterflies' wings somewhere, setting up this chain of reactions, and it's possible to think about that. But he talks a lot about fractals, and if you zoom in on different time frames, you see the same pattern. So the idea is, like, this leg up here actually has this impulse wave in between it. And in fact, if you were to zoom down here, this leg up also has the and you see that, right? So like each of these has this type of structure within it, and this down leg here also has an impulse leg within it. And people say markets are fractal. I think the more precise way to say it is that they're fractal-like. They're a lot like fractals because you have issues of liquidity and tick size as you get down to lower time frames that change things. But this is the basic underlying structure that is here. But now let's look on the chart. Do we see this structure? I'm just going to highlight it in a few places. But if I tell you it's the basic underlying structure, what you should expect is, okay, Adam, so it should be there all the time. And like, here's a very clear example of where it does seem to be. Here's a less clear example of, see, this leg up, this leg down, and this leg up seems to be there. This seems to be here, down, up, down. Now, what about this? So you see, if I make a mark, it's not easy to erase that specific mark, but you see the space in between those two lines. It's not quite so clear here, right? If you zoom down on a lower time frame, you would undoubtedly see that there is some stuff happening in here, but it's not so clear on the chart. See, but this probably resolves into some kind of more complicated leg like this. So the point is that these idealized structures, and this is why we're not going to do, I'm not going to give you hours of video here filled with diagrams like this, because when we actually get down into the dirty real market, we need to see how these things apply. And this, I will tell you, even though it looks like the structure isn't here very clearly, it actually is. And this would shape this is, by the way, a 5-minute chart of the S&P. And one thing that I'm doing here, I really want to focus on giving you things that are kind of happening right now. And I am deliberately not going back and looking for the best examples of charts or some of these things. I want you to see, like, if you were dealing with this on the 25th of May, 2022, so this is the overnight session. What kind of structure would you have seen? And let's also just give you a little preview of what we're going to look at later in the course, or later today. This is we're going to see this again. Look at this little structure here. And look at this little structure here. Now, these are pullbacks, right? This is one of and this is something that if you have read my books, this is a pattern that I certainly was aware of, but I had not used in a formal sense. And as I continued to do daily market analysis and then talk to people about that analysis and to teach, I started to see this pattern more and more. And I think this is one of the more important things you need to think about. This is what I call a nested pullback, and I'm not super impressed with my terminology there. But a nested pullback is, I'm going to draw schematically here. So you have a market that's downtrending and it goes up into a pullback leg. And the classic outcome is that, right? That's what we look for. But in a nested pullback, you go up and you have the pullback, and then the pullback starts to work, and then you have some kind of little pause. And this little pause, which may be a pullback, it may be just one or two small bars, but this pause is a very useful way to get on board moves. So what you're looking at here in this one, you had this pullback, which this is quite an extreme pullback, but on intraday overnight data, this is into the open of the European session. This is it's something you need to understand if you trade intraday charts, is that time matters a little bit. That makes this little move here, which doesn't seem particularly compelling, sitting right here on support. That's a very powerful pattern. Look here, this is another, relatively simple pullback. It's actually technically what we call a complex pullback, but this is just a pullback that melted lower. Look here, here's a bigger pullback, and then look here. Look at this little pause. See that? That's the nested pullback, and that's the little side road we took here. I'm going to show you more examples of a nested pullback, and this also is a nested pullback. Now, why do you need to know about nested pullbacks? Short answer is they happen, and if you know about them, you can use it. It's a useful tool for entering and exiting trades, or rather for not exiting trades, because if you don't know what's going on here, and let's say your magic crystal ball was working and you got short on this bar. Very good job, good work. And then let's say you're sitting here and the market makes this little pullback, and you want to, in this case, we haven't talked about exit strategies, but let's say you're going to play for the biggest move you can, and market makes this little pullback. You're like, oh, it's going up against me. Do I hold it? If you understand nested pullbacks, and you understand that the pullback here is very likely to generate some pauses, you're not going to be concerned. Or, if you took partial profits, you could even use that inflection to put trades back on. So it's very important to understand this nested pullback, and I'm going to explain it again here in a few minutes, as one of the really fundamental structures of how markets move. Another thing to talk about here, and I don't want to get too distracted by this, but the measured move objective. I'm going to go back a couple slides to that simple schematic. So the measured move objective, what it does is it takes this leg. So let's call this the setup leg. Let's call this the pullback leg, and then let's call this if call it the setup, let's call it the result leg, okay? So what the measured move objective does is it measures the size, and we can look at time. Let's just look at size first. It measures, and that's not precisely done, but it measures the size of this particular leg, of the setup leg. And then it says, okay, so this setup leg moved this much, and then it takes that same expectation and moves it over from the bottom of the pullback leg and says that the size of the resulting move, so here's your setup leg, here's your pullback leg, the size of the resulting move should look like this leg. And whether the pullback itself is very deep, you're still going to get the same thing. If the pullback itself, I'll just draw over everything here, is very small, you're still looking that this leg looks like this leg. This leg looks like this leg. That's the concept behind the measured move objective. Now, does it work? Well, yes, it works. It works sometimes very well. Here is a pretty good example of where it works quite accurately. But look here, and it's a question of, do you take this as the setup leg or this is the setup leg? But if you were to look here, we had a fairly significant extension. So what I'm saying here is, let's call this leg 1. Let's call this leg 3. Leg 3 is quite a bit bigger than leg 1. So what's going on here is that the measured move objective is a useful way to look at markets because it gives us a reasonable expectation. I'm saying for the second up leg here, and that's in this kind of structure, but is what I just labeled leg 3. So you have leg 1, and then the pullback itself would be leg 2. But just to be clear, that's what I mean here. It's a reasonable expectation. It is not a hard and fast rule. It is not a line in the sand. Those things don't exist. That's one reason why I'm so critical of the way so many people think about Fibonacci, because they think, oh, like it's an absolute thing. No, it's a reasonable expectation. And here's why it works. This is also why Fibonacci works and why people get confused. So this is the expectation is based on the assumption that future volatility will equal current volatility. Now, it so happens, how good does that assumption seem to you? Seems kind of naive, right? Because what we're saying is the future is going to be like the past, and that seems lazy. It seems like you're right. However, that's actually a very, very good assumption, because there are thousands of academic papers published on forecasting volatility. When we forecast volatility, what we do is, we look at what's happening right now and we say, here's what's going to happen in the future. That's, with any kind of forecast. And it turns out in those thousands of academic models, you can easily search Google, find many of those papers if you want to read them. A lot of those models are very, very similar. And one of the strongest factors in all of those models is current volatility. So even for super sophisticated quantitative work, the best place to start, what's future volatility going to look like? The answer is current volatility. So this is not a naive assumption at all. This is actually legit, and I'm belaboring this point because it's important. This is a powerful and valid way to look at markets. And as I said, just treat it as a guideline. This is the key here, and this probably should be an orange text or something. The measured move objective will be violated, will be wrong if volatility changes. And that's what happened here. That's why this leg is longer, was because volatility increased. And here's another case where it worked reasonably well. So just understand that if you're looking at a market and you have a reason to think that, let's say the market's swinging really crazy right now. Let's say it's a stock that just got an upgrade or downgrade, or just reported earnings or something, or a crop report just came out in grains or something like that, and the markets, or our central bank made a decision, a currency or interest rates are moving. Do you really think that volatility is going to continue in the future? Or you think it's probably going to die down? There you have some reasonable, expectation. Conversely, if one of those events is going to happen in the future, very classic example when this happens is when we know the FOMC report is going to come out, and we know markets are likely going to make a big volatile move in response to that information. So if volatility is going to change, that's when you know that your measured move objective is likely to be badly off. But if you're just looking at normal markets, that assumption that the future will look like current data is actually a reasonable assumption. It's also important to understand volatility in at least two ways, and this is something that we could actually speak about for hours. But volatility, as it is classically measured, you're looking at how much something bounces around. It's a measurement of uncertainty. And that is certainly valid, and it's the way options price volatility. It's correct. There's another kind of volatility, though, that really matters for traders, and I think about this as more directional volatility. So if you have a market, and this frankly is not something that academia is very well in tune with, but you could have a market that, so volatility, that's higher volatility. There's one is more unpredictable than another, but you also can have this result in a market making a clean move, our market making a less clean move. And this is a different kind of volatility that is hard to measure, but it's also correct when you're thinking about future outcomes of your trades. And in fact, I think this is the point where we begin, is trying to understand how is the market likely to move in the future. One of the ways you build up that knowledge and that expectation is by looking at a lot of data, by seeing a lot of charts, basically. Let's talk about momentum. So I believe the statue here is a statue of Janus. And if somebody is more in tune with classical sculpture and I'm wrong, tell me I'm wrong. But here's what I do know. Janus was a Roman god that had two faces. And he was the god of beginnings and endings, of war and peace, things like this, of planting and harvest. And this is a very apt comparison to momentum, because momentum is the way to think about momentum. It's a little bit hard to define with precision. We'll come back to this. We'll come back to the definition in a moment. Let's talk about it like we know what it is. So momentum is something that comes at the beginning of a trend. If you have a quiet market and then all of a sudden, boom, there's a move, that's new momentum. That's an explosion of buying or selling pressure, depending which way it goes. And if you see very convincing momentum come out of a quiet market, that shows us that this move is likely to continue. However, the other face of momentum is if you have a market that's trending along, we talked about this a little bit in the previous session, right? And then all of a sudden like explodes up higher, that explosion of momentum in a ongoing trend, because you got to be careful, right? I almost said in a mature trend. Well, what's a mature trend? Because let's say you have a market that's trending for, oh, I don't know, I mean, look at the stocks, which have basically been trending since 2009 upward. There have been some sideways years, but we've been in a very, very long-term bull market. And anybody who wants to argue against that is playing very silly games with definitions. We've been in bull market since 2009. That's obvious to, I like to use the phrase any idiot, but whatever. That's probably unkind. But if you have a market that's trending that long, at what point was it mature? Because a lot of people would have thought that bull market was mature 3 years into it. And here we are many years later. A lot of people certainly would have thought it was mature 5, 6, 10 years into it. So you do have to be careful that when you use, there's so many assumptions baked into our language. But if you have a trend that is underway and then you have momentum explode in the direction of a trend, that's one of the classic ways trends end. So one of the mistakes that people make, and this goes back to what we were talking about in the previous session, trading around climaxes, where you see this new momentum and you think, oh, everybody else wants to buy, I'm going to jump in and buy. What you've done here is you've fallen into one of the typical traps. And momentum, as I said, there are a lot of definitions of momentum, and the one that I'm using here is basically how fast the prices move. If you're looking at a chart, it's how vertical, up or down is the move as opposed to sideways. All these other definitions that I've grayed out here are also appropriate. How do we measure momentum? Some indicators are very helpful here, and one is the MACD fast line. And for those of you who have not seen my work, the tool that I find particularly useful is a MACD that uses these settings, 3 and 10 for the fast line. These are not the typical settings, but this is a setting that was used by a charting service back in the 1980s, I think maybe even back in the 1970s. So what you have is you have this large body of old school traders that use this tool, that understood this tool, and so it's kind of deeply ingrained in a lot of people's brains. But many modern charting packages, you have to massage it a little bit. So you use 3 and 10 for the fast line. You use 16 for the slow line, and that people use signal line, sometimes the term that's used. And the thing that is perhaps most difficult to set with modern software is you want to make sure that you're using simple moving averages here and not exponential moving averages. If you use exponential, you'll get quite different lines, and the tool does that. The tool's still useful. You can also use stochastics, you can use CCI, you can use a lot of different indicators can be used to help measure momentum. But just so you know, the one that's on my chart and the one that I use is this 3, 10, 16 MACD, made with simple, not exponential moving averages. And we also have no MACD histogram on the charts. You put it on there if you want. Sigma spikes, I've written about this extensively. We're not going to really talk about this much in the course. It is on the charts. If you want to know about Sigma spikes, you can easily search, go to Google, type Adam Grimes, Sigma spikes. Sigma spikes actually will probably get it done, put it in quotes, and you can see precisely how to calculate it. It's no secret. It's just basically a measure of big moves. One of the really, really, really effective ways is to look at a market making a move to the Keltner channels, particularly the first touch. And I'll show you what this means. You can also just use your eye and look at a chart and say, oh, there's good momentum, but you do need to be careful because that is a wildly subjective definition. And as you get more data on the chart, it might look different. But if you are just looking at a chart, which again, I'm not criticizing, it's not necessarily a wrong way to do it, but consider whether you're going to look only at one single bar, or will you look at a set of bars that can show you momentum over a little bit of a longer swing. I also want to talk a little bit here, and I have 4 charts, which I'm going to page through with a little bit of commentary, but I would like you to spend some time pausing the video and looking at these charts. So let's talk about momentum divergence. So what momentum divergence is here, and I'll try to use some colors just to clarify. You have the market. Let's say, and I'm going to draw a very abstract market here. You have a market, so this is price, and price makes a higher high, and then underneath price, I have a momentum line, and the momentum line makes a lower high. So this is a classic momentum divergence. Price makes a higher high, and momentum, as measured by some indicator, and you have to obviously measure in some way, makes a lower high. What this is supposed to show us is that this leg here, and let's just number things 1, 2, 3. So leg 3 was made on less momentum, weakening momentum, and therefore it shows the market is losing steam, and it shows us that future legs are likely to not be really impressive, that the trend is likely to lose steam. You can flip this upside down for a momentum divergence for the downside. I won't use colors here, but you have a market that makes a lower low. This is price on top here, and then here is a momentum indicator, and what it shows here is that the second leg down was made on less downward momentum, meaning that you're not likely to continue to see further downside. A lot of people will tell you momentum divergences. I'm sure you can find many people who tell you it's the most important signal in technical analysis. Is it? So I just took the daily chart of the S&P futures. This is a continuous futures chart. I went back to 2019. I would argue that if momentum divergence is in fact a super powerful signal, I didn't carefully select these charts, but certainly going back over the last few years of the S&P, we should see more momentum divergences work than not, right? Let's look at one that works here. This is a classic one that works. So what I've done is not to bury the lead, but the green lines. So I'm marking here, and I'll spend a little bit of time on this just to make sure you understand, and then you can go through it. You have here a market that has made a lower low in price, right? This low is lower than this low. And on the momentum indicator down here, you have a higher, or at least not lower low. So this is a classic momentum divergence. And what this would tell us is when we see the momentum divergence forming here, this would tell us that it was at least kind of silly to look for further downside, and maybe we even look to a reversal to the upside. It worked. However, look here. We have a higher high in price and a lower low on the moment. I'm not going to go through all of these, but the red lines are failed momentum divergences. Now, you might define some of these divergences a little bit differently. There are questions about which points do we look back to, but I would encourage you, particularly if you are a trader, because this is me, this is where I came from. I thought momentum divergence was an incredibly powerful signal. And then I went through and looked at a large set of trades that I had done, hundreds of trades, and I separated them by did they have so these were trades with outcomes. They were finished trades, and I went down Periscope, as I say, and went into my office and spent several days going back through these charts and categorizing the trades by trades with and without momentum divergence. I would also gently suggest that most people who tell you that momentum divergence is very powerful, they have not done this kind of work. So do this kind of work yourself, see what you think about the tool. I'm without much commentary here. I'm going to spend a couple minutes, and not a couple minutes, I'm going to spend 30 seconds. I'll page through the next 4 slides. I would encourage you to stop the video, look deeply at each chart, and then maybe, all this is the daily S&P from 2019, maybe do the work yourself. So let's just take a moment here. The green ones are the ones that worked, the red ones did not. There also is a little bit of overlap between the end of this chart and the beginning of the last one here. And I think, actually a lot of people would mark a momentum divergence here too, which we could, well, I mean, that technically is higher. This is higher momentum. And, like I said, you have to be very precise in how you do and define these things if you're going to use them. This one is black because I think you could say it either worked or it didn't. We're considerably lower, but depending on your trade expectation, and this is quite important, could you have had a profitable long trade here? Yeah, absolutely. If you're a swing trader, so this could be green, or you could call it a failure because we're lower. So just take a look at momentum divergence. If you don't use momentum divergence, if you're relatively new to trading, you're going to hear a lot of people talk about momentum divergence, and people will talk about it in glowing terms. And I would just encourage you to, and there are other kinds of divergence. People play other games with these indicators. I'm not ignorant of those. People talk about reverse divergences, and there are all kinds of ways. I've looked at those too, but I'm just showing you kind of the plain vanilla here. So let's talk about how trends begin. Two ways: with a momentum spike. So you have a market, let's just imagine a market that's chopping around sideways. I believe I have the wrong ink color there, right? You have a market that's chopping around sideways, and then boom, has a big move to the upside, clears a bunch of resistance, just punches to new highs, and then we see pullbacks form, and we see the market trend to the upside. This is number one. Number two is you have a market that's chopping and then kind of gradually picks up steam. So here, maybe you could, in retrospect, go back and identify a breakout, but it's just kind of this like slow ramp of a takeoff. The thing about both of these is they both feature successful pullbacks. Now, one of the things that I casually dropped in the first session, which you might or might not have caught, is that the pullbacks are a tool not only to put on trades, but also to analyze a market. If you understand pullbacks, you understand how pullbacks evolve and work and fail, then you will be equipped to understand the trend dynamics and the psychological framework that's in place in any market at any point in time. And so here, the presence of pullbacks that work will tell you if a trend is underway or not. Now, this also means that we need to be comfortable missing a trade. And this is, kind of anti-FOMO. We've talked about FOMO several times. If you see a market, let's go back here, and you have this big boom, and then you have a pullback, and then the market goes higher. If you see that kind of thing, let's say the market had been sideways for a while, and you think, oh, I am such a bad trader, I'm such a failure, I missed this trade, and then you go and sulk and you don't look at the market for for several weeks. Well, what you're likely to find is that this is what happened. And because you were kicking yourself in the head for missing this trade, you also missed this trade and this trade and this trade. So there's even a way to approach these things as you think about where you want to trade. You might decide, I'm very comfortable missing this first trade. I'm going to look for these subsequent legs. Here's new momentum on a chart. So I told you, let's look at the ugliness of some real markets. Here you have a market that was, I believe this came from up here. So I think we were downtrending. We might have been sideways, but we have new momentum here. This is the kind of a failure up here. Let's just look at where we touched the Keltner channels. So you touch the upper Keltner channels here. And this is a case where it did not work, this first one. But let's look at the second one under the green arrow. What this shows you is that this move had some real punch behind it. You also can see that the MACD makes a new high relative to recent history. What's recent history? On a daily chart, take about 2 months. So you're looking at about 40 bars if you use the 310 MACD that I use. If you use a different tool, your look back window might be different. But this is just showing, hey, this market has really woken up. What we would not want to do is go back and compare to something a year ago. That's not, this is a shorter term tool than that. The window where it's important is not so important, or is not so long, sorry. But once we see this new momentum, what this tells us is there are likely to be further legs to the upside. Now, this was an ugly stock to trade. This was not easy to trade, and we would, this was not really on our list to trade. But oh, also look, momentum divergence, right? So when you see that momentum divergence, it tells you it's probably not going higher yet. Here we are. But again, depending on your trade management, and like I'm deliberately showing you some of the complications here, but again, I would not be too concerned about momentum divergence. Look what happens here though. So this leg where we do decline, we don't get down to the lower Keltner channel. In fact, let's look at where we touched the lower channel here. Did we touch here? I don't know. I think maybe we did not, but we definitely touched here. And then you go through this long period where we don't touch until here. And we certainly don't have a close. That's another way to look at it here, is a close outside the channel. This bar is the first close outside the channel in a long time. And this lines up with this eventual low in the MACD, which is new momentum lows. So what this shows us here is that this move, and again, it's pretty obvious on the chart, right? Like something happened. It's a pretty dramatic failure, but this new downward momentum shows us that we may be beginning a downtrend. Let's look at another example. New momentum here. So you had a market that was kind of chopping sideways here for a while. We go down to the lower Keltner channels here. And the last place we tagged them was here. We also had here, and not super convincing, but a little bit of new lows on the MACD. And then what happens? We have a successful pullback. And we actually had a successful pullback here, right? But maybe this was the one we were comfortable missing. But look, if you were looking to trade this to the short side, let's say you missed this pullback and you just throw your hands up in frustration. You say, I'm not going to look at the market anymore. Look what you missed, right? Or if you missed this pullback. Well, what about this one, right? This one's a little bit hard to trade, but you see the point. And then look what happens here. New highs on the MACD here, and eventually we get up to the upper Keltner channels, and this is crude oil. Now this is back adjusted, but we're well above $100 today, so this is crude oil in the middle of 2020, and pretty much the outcome after that looked something like that. So new momentum is a sign of a new trend. Here's a much more difficult place to see. This is following the 2008, 2009, which, I extend back to 2007, because we were trading pretty aggressively on the short side prior to 2007. Following the financial crisis, the market started a bull market in 2009. And I'll tell you this, these are the futures. This is not the cash. These prices aren't right. If you're wondering if we caught this in real time, I don't have records to prove to you that I did, but I'll tell you what really happened. My trading partner at the time, who was not a technician, he saw something I didn't. He turned around, his desk was reminding, he turned around the moment that we had ticked the low of that extreme low of this move, and we printed like 666 on the cash, and he turned around and he said, that's it, that's the low of the market. He literally called the low of the 2009 bear market to within 5 minutes. I missed it. Where I got on the party was here in late April, somewhere in this area. Became apparent that the market had stabilized. I was sensitive to this new momentum to the upside, and the fact that we were, and then within a few weeks, we were able to press into that upper Keltner channel. Look, this goes back to April of 2008, and there's really, if you're looking at the upper channel, we don't touch that upper channel. We can't quite get there. This is a really, really powerful way to look at markets. Now, Adam, you're supposed to be talking about trading pullbacks, right? I'm giving you the structure within which we trade pullbacks, and that's very powerful. But this is this 2009 is deliberately less clear, but this does set the stage for an extremely significant and ongoing bull market in stocks. And at least one person, either through luck, I like to think it was a little bit of luck because I missed it, but somebody called it within 10 minutes, and I was a little bit late to the party, but I was there within 2 months. And this is something that if you spend time here with understanding charts, understanding how markets move, this is not a superhuman thing. This is something that anybody can learn to do. You will not always be right. I'm not always right by any means, but you will be right you'll be right more often than not. And when you're right, you'll be right in big ways. And that's the whole point. How trends end. Climax or support and resistance holding against the trend. Let's jump on to these because we've already talked about climax quite a bit. Let's get more specific. So in a climax, a trend generally accelerates. So broadly speaking, if you're looking at a market that's trending like this, trending up, and then it goes like this, and then it goes like this, like what do you think if you don't know anything about markets? Tell you what I thought when I didn't know anything about markets. One of my first trades, I do think it's my very first trade, was buying a market that was doing this, because what you think when you see this is it's a ramp and it's going to, gosh, look how great this looks. But actually the acceleration of the trend shows that we're reaching a point where everybody who wants to buy has bought. And this is a very important concept. I feel like there are some nuggets here that potentially, like there's some sentences that I'm going to say that could be worth the entire value of the course, and this is one of them. Conceptually, what moves markets is people changing their opinions. This is very, very important. So we think that a market is going to go up when everybody is bullish. Nothing is further from the truth. What makes a market go up? When people buy. Okay? When do people buy? People mostly buy when, imagine you've been short. Imagine you've been short and the market's going up, and then you go, darn, you say something that can't be repeated in polite company, and you close out your short position. How? By buying. Or let's say you've been on the sidelines neutral, and it's finally gone up enough that you're like, okay, I'm bullish on this, let me go buy it. So it's that execution of all that matters in markets, and this ties in, right, is what people do. And it's people pushing that button or picking up the phone to execute that buy order that makes a market go up. If everybody is bullish, what? If everybody is bullish and everybody has already bought, they're not going to buy more. So that's the key here, is that it's people switching camps. And when the market looks its most bullish, when you get into a taxi cab and the taxi driver starts talking to you about a market, that's what, or when it shows up on the cover of Time or Newsweek, maybe not Time, but maybe when it shows up in the popular media, when USA Today, and at some point this will happen, they're talking about coffee prices or something, that tells you the move is probably over, because it's just gone far enough that it's that seeped into the general mindset. Volatility will increase in a climax, sometime to an extreme, whether you measure volatility by ATR or HVOL. So HVOL is historical volatility. That's a statistical measure that looks at close. We've written about this in a lot of different places, and this is not a course on volatility, so we're going to talk about that in detail. But just be aware that ATR, average true range, was just a measure of the size of the bars on a chart. Again, this looks like kind of a naive measure, and it's a measure that technical analysts have been using for a long time. And a lot of quants like to say, oh, technicians don't understand anything. But in this case, ATR is actually very useful. And you can just use your Mark I eyeballs and look at a chart and see when the bars start getting very big. If you've had a market that's been trending for a long time, and then the bars start to get very big, danger, right? One of the other things that is important to look for is the present, or to notice when it happens. Maybe not to look for, but to notice, is free bars. And do know that climaxes are often followed by dramatic reversals. Here's what it looks like on a chart. So here's gold, and the area under discussion is here. So this is a climax. And the first thing I want to point out is what happened after the climax. The market collapsed. So this is the danger when you have a market that everybody is leaning in one direction. Everybody is bullish. and it's never everybody, right? And it's never as simple as I'm going to make it sound. But let's take it in that simple sense. If everybody is bullish, if everybody who wants to buy and is able to buy has already bought, the only thing that can happen is people can sell. It's never quite that extreme, but that's the thinking. And that's what happens at these climax points. Everybody who wants to buy has already bought. So only bad things can happen to the market. This kind of reaction after the climax is very, very typical. A free bar. So free bars are bars that are entirely outside the Keltner channels. They are quite rare. This is a free bar here. See, the low of the bar is above the upper channel. Here's another free bar. They're really not common. I don't believe, yeah, there are no free bars to the downside on this chart. Many charts you pull up will have no free bars. I use Keltner channels, set 2.25 average true ranges around a 20 period exponential moving average. I'm actually going to take the time to write that here. So the Keltner channels are set around a 20 period EMA. I think these are actually really called Stark bands, but we all call them Keltner channels, and I'm not going to change that. So 20 period EMA, not simple moving average Keltner channels, typically around a simple moving average, and they're set 2.25 ATRs above and below that average. So those are the channels I use. If you use something different, you can. In my first book, I made a pretty good case for why I use Keltners instead of Bollinger Bands. Bollinger Bands are still probably more common. I think there's a good reasons to use Keltners instead, but if you use different settings, you will obviously have different free bars, and you certainly can have Keltner channels or Bollingers that are set so extreme that you never have a free bar. But I do find the presence of free bars here using the tools that I have a very good indication of potential climax. Also notice it's not quite as clear here as in some other examples, but look at the size of the bars here, okay? And then look at the size of the bars here. It's bigger. Maybe not, in here. I'm going to erase these lines so you can see. So, look at the size of the bars here and look at the size of the bars here. They're a little bit bigger. This is not a case where it's particularly hugely dramatic. Here's another one. So this is crude oil into the COVID-driven collapse, and gaps are another indication. You have seen this chart recently. Gaps are another indication of climax. Here's a free bar, gapping, boom, way down below. Also, price, commodity going negative, which happened with crude oil, is another indication of climax and some potentially really crazy stuff going on. But here, look at, I think maybe the big takeaway here is just take a moment, look at that. 3 seconds, look at that. So your eye has accepted the size of the bars there as being normal. Look here. This is what was actually normal. So even though, and this is a case where, if you're measuring ATR or something, you would see that volatility is dramatically higher on the right side of the chart as opposed to the left. Your eye might miss it though. And that's a very important thing as you're looking at charts to be able to pull out. Here's another example of climax. Look at all the free bars. Look at the number of free bars that were completely under the channels. Look how much larger these bars are than what was typical before the decline. And the point here is that, if you lived through this time, you might have thought that everything here was going effectively to zero. And, there was definitely very, very good reason to be bearish, but all of this type of climactic move was thinking back to what we did in real time was warrant, like I don't want to just give you like abstract academic things like, here's what happened. We were looking to short, but we were aware that a lot of things looked really climactic. So once we got, you're going to see another theme here. Once we started to get action like this, I'm using Exxon, but we were looking at indexes mostly. Once we started to get that kind of stabilizing action following what looked like it might have been a climax, then it was easier to define, hey, that probably was climactic, and that allowed us very quickly to, indexes went up here, much much more smartly, I guess, than this particular chart, but that allowed us to get on the bullish side. So, a lot of this is a lot of navigating market environments is not really about being definitively right, but it's about modifying very quickly when you're wrong. Climax and reaction. Here's S&P into 2018, and just look. I'm going to draw. These are not trend lines. I'm going to draw just basically indications of slope of trend. So, and you see here that's exactly what I'm talking about. That what I was talking about earlier with this acceleration of the trend. And if you didn't know what you were looking at, you would have thought that looks super bullish. And then look at the free bars here. You certainly see some free bars in the S&P, but you don't see a lot of them. And then look what happened. Boom, right? Classic, absolutely classic. Look how big this bar and this bar is. Look how big those bars are relative to anything in this area. So volatility increased hugely and dramatically. Classic. So one thing to think about is when you see a climax, and this goes back to what where I was talking about that Exxon chart, is it really over or are we just taking a break? One of the things we're not talking about today, which we'll talk about a little bit in the next session, is price acceptance, which is kind of a strange term. You don't hear that very much. You're more likely to hear price rejection, because that's how most technical analysts think. If the market is able to stabilize after a climax, this can point to continuation. Now, I just told you that the stabilizing here pointed us to a reversal. It was the way the market stabilized. Guess what? It did not stabilize in a way that looked like a bear flag. Just to put it very simply, we saw a different kind of stabilization that showed us that maybe the bulls were taking control. I'm going to untangle that for you. That's not a mystery. At the very least, here's the takeaway. When you see a climax, it's usually a bad idea, a very bad idea to trade right after a climax in the direction of the previous trend. You want to be super careful. But here's a current example of where you might be able to trade in the direction of a climax. This is crude oil as of yesterday's close. This is clearly climactic, right? Look at this action. You look at the slope of trend. You've been trending here, and then you go almost vertical. People say parabolic. It's not mathematically precise, but it's a term that people understand, which is where you have a market that's trending and then it ramps up like that. So people call this a parabolic move. Fair enough, it's fine. And here's another one of those little clues that I think could be worthy. Yeah, if this were the only thing you took away from the course, I think you got something very valuable. If you have a market that makes a big move and then an almost equally big move, or maybe a little bit bigger, not quite as big, but almost an equally big move in the opposite direction, your baseline expectation for outcome is some type of triangle and consolidation, which is precisely what we had. Now, you should always be suspicious when somebody shows you something on a chart, but we got this in real time. And those of you who have access to the daily market videos that I do, you go back and look at what I was saying. Like, this was something we identified that, it's probably not an easy trade here. We're probably going to chop around. Let's leave crude oil alone for a while. However, look what happens. Now we're stabilizing higher. So what this shows us is, in a very broad sense, that just think about this. The market went up here and we saw price rejection, right? It didn't want to be there and the market collapsed. Okay, so that's fine. But then if the bears are going to take control, we're going to see rather immediate selling. If we see this price rejection somewhat nullified, this is not what's happening, but I'm drawing a very idealized thing, that we're able to consolidate more up near the extreme of the price rejection. That is a super clear bullish setup. However, it's not quite as clear. This is why a lot of people are missing it. But the fact that we're setting up down here, this is very likely bullish. So this is one reason why we're pretty bullish on crude oil. And it's not based on fundamentals. It's not based on any kind of arcane analysis. It's based on this analysis of trend dynamics. Okay, let's talk about chart patterns. So that's the way a lot of people trade. It's the way I started trading. The classic book of chart patterns is Technical Analysis of Stock Trends by Edwards and McGee. People call it the Bible of technical analysis. What we have just looked at, this is pretty cool. This is really cool. So, there are all these different patterns. Heads and shoulders, probably the most famous, but there are a lot of patterns in that book. And in one of the free courses I have out there, I have a really cool module, which kind of makes me angry. Like nobody's picked up on it and really paid attention to it. But I think it's one of the neater things I've ever done. I go through and I look at a lot of the patterns from the Edwards and McGee book, and we look at what drives those, what dynamics. Well, you've just seen this interplay of buying and selling pressure, the impact of potential climax at the end of trend, the impact of fresh momentum, of overextension, buyers and sellers leaning too far in one direction, getting a little bit tired. This is what makes all of these chart patterns. This is what's behind the chart patterns. I never look at a head and shoulders pattern. I haven't looked at a head and shoulders pattern since 1998. Yeah, probably. And I've never concerned myself with whether something's a pennant or a triangle or a diamond or whatever. Those details of the patterns don't matter if you understand the bigger picture dynamics. Now, we're going to look at specific patterns here in a moment, but I think that this is a way that is useful to think about markets. It's a way that's useful and profitable for many, many traders. It's also, by the way, here's something that nobody likes to tell you. Edwards and McGee were not traders. Neither one of the people who wrote that book were able to take the information in that book and make money trading. So if I think we're in like the 12th edition of Technical Analysis of Stock Trends. It's one of the triumphs of marketing, but it would certainly be a little bit suspicious to me to know that those guys never made money trading it. So do with that what you will. But now with that background of me just throwing a whole bucket of shade on that's not a thing, right? On chart patterns, let's look at some chart patterns. So I do think the key here is understanding what a pattern is doing in the overall market structure. And one thing that I would encourage you to do, somebody just hit me on Instagram of all places and found me at a vulnerable moment where I was watching television. And so I chatted with the guy who was asking basically about should he just focus on A plus setups, or what about his B or C setups? And his first question was, is it normal that A setups are relatively rare? So of course, that's common with everything, whether you're talking about apples or even quality of days that you have. Like the exceptional ones by definition are more rare. But then what I challenge him to think about is, are your A's really better than your B's and C's? And you need to go through and evaluate that. One of the surprising things that I found when I did this work, and again, a lot of people I don't think have done this work, it's very difficult to do, to avoid getting contaminated, avoid resulting, which I put here, and that's a term from the Annie Duke book, and I don't remember the title of that book, but it's definitely a book that traders should be aware of. Resulting is where you evaluate something based on the result. And you're like, well, how else would I evaluate it, Adam? Let's. I won't use a story or whatever, but let's just say that you can make all of the right decisions, particularly in the market, wicked learning environment, right? Just tying from previous session, and have a bad outcome, or you can do something very stupid and have a very good outcome. But where we get in trouble is if we do something very stupid and we have a good outcome, and then we say, hey, what I did there was actually a good thing because I made a lot of money doing it. That appears to be something that's impossible to argue with. I made a lot of money on this trade, but if we don't understand that I actually got lucky because I was doing something very stupid, eventually we're going to get hurt, right? So that's the point of resulting. You need to be very careful not to evaluate the quality of your decisions by the quality of your outcomes. And if you're evaluating does the visual prettiness, and it might matter, right? Because we might be looking at symmetry and consistency, volatility, and stuff like that. But if you're going to try to evaluate that, you need to be careful not being contaminated by the outcomes. Few catalogs, a few specific pullback variations here. So simple pullbacks, I'm going to draw these schematically for you. So here's a simple pullback. All of these will be a market in an uptrend. I've drawn this like 5,000 times already, so you're already sick of seeing this. This is a simple pullback. Now a complex pullback looks like this. Here's a complex pullback. You have the market makes this leg up, and then it makes a leg down, then another leg up, and then a leg down, and then continues up. Whoa, what's this? You've seen this before? This is that impulse wave that we started, right? So all this is showing is that fractal nature of the market's kind of spun out. There are other more complicated variations of complex pullbacks. There's no guarantee it's just going to be one leg. It could be something like this. But this is a, you know, as opposed to a simple pullback, which just goes up and then down and then back up, you spend some time kind of chopping around, and they're a little bit difficult to trade. Nested pullbacks we talked about. I'm going to clear these lines. Nested pullback comes up, and then there's some kind of little pause here. And it might be a pullback itself. The pause might be here. The pause might be here. You might even have multiple pauses. Your pause might look like this. These are nested pullbacks. It's important to understand. Now you got to watch them because maybe they're going to fail, right? You know, don't pretend that anything works. If you see this, that's a possible outcome, but monitoring that will help you manage your trade. Fast and tight pullbacks. I'm not going to talk much about this, but what this is, you know, a market that's trending. Sometimes in a trending market, you might have to treat a single bar as a pullback. Typically, it would be an inside bar. An ideal example where I would see that, you know, let's go back. So you have this market that's chopping that I mentioned, right? And then the market makes a big move up. Okay, so you, like I said before, you cleared a bunch of resistance, new upside momentum. Maybe we've tagged the upper Keltner channels. So now let's zoom into this area and I'll draw single bars. So, you know, if you have single bars that look like this, and then you have something that looks like this, you might, depending on how aggressive you are as a trader, you might with that single bar, or maybe you would require two. It's not really enough to call it a pullback, but particularly if it's an inside bar, you might treat it like a pullback, and you might treat it as you know, potential entry point. We're not going to talk much about the ante today. We'll talk a little bit more about it. We're not going to talk at all about it today, but this is a very special pullback that's not that common. But I'll tell you a good place for it. So you have this trending market, and the market, I can do better than that, sorry. Market goes climactic, okay? And then you have this boom, this big reaction against this pullback right here, which could set up another leg down. This is the ante. So what you look for is, you know what? I actually don't know if it's here. Let's go back and look at these. Yeah, it's not really here. I'm just scanning really quickly. Yeah, okay, so I pulled examples where it really wasn't. As I said, it's relatively rare, but when it does occur, it's a you know, very reliable pattern, very powerful pattern. It's also one where we tend to treat it, the measured move, a little bit more strictly. So these, however, these first three, simple, complex, and nested. Again, I'm not going to spend a lot of time here going through the details of these charts, but I'll just let you look at them here for a moment and pause the video and really absorb these. Just to, you know, just a few comments. So all of these are just simple, classic pullbacks. Small pauses, but this is what it really looks like. These are the variations of what, some of the variations. And here's one which maybe is a little bit of a fast and tight pullback. It's just two bars, right? Here's one, this pullback here. However, look what happens here. You have a little bit more complicated structure here. And this pullback is actually a complex pullback. So these are complex pullbacks. Look at this one, multiple legs, right? So it's a pullback that has a little bit more chop to it. Look here. So you see this single bar in the middle, which shows us that we had a leg down, we had a little bit of stabilization, and then another leg down. And these legs, in this case, the second leg down is just a single bar. Look here. Same thing, right? It's a complex pullback if you go down to a lower time frame. This is not quite as clear, but you can see some structure here. Complex pullback here. And here are some examples of the nested pullbacks. So I'll just circle the nested pullbacks here, and then I will clear the line. So if you're pausing the video, you can choose whether to see my lines or not. And notice that some of these nested pullbacks are actually relatively healthy and complete pullbacks themselves, as this last one I circled. Some of them are tight pullbacks. But if you aren't aware of that structure of the nested pullback, it's very easy to, let's just take one here. Let's take this one. It's very easy to say, oh crap, look, so my trade took off and now what's happened? I'm flat for a couple bars, I'm gonna get out of the trade. If you understand the nested pullback, you see that's probably not the way to think about it. One other thing that I wanna wrap up with here is that do be aware that nothing works all the time, and you will have sustained periods in markets where you don't have pullbacks or where you don't have tradable pullbacks. That certainly happens. And here's where you really get in trouble. This happens in some of the strongest trends. Why do I tell you that? Because it makes you vulnerable to fear of missing out. It makes you think that I should have a trade here. I should be catching this move. Your job as a trader is not to catch a move. Your job is to trade solid patterns when they show up, solid patterns that are captured in your trading plan. Summary, markets trend. There's debate on that. People who say they don't trend are wrong. Markets do trend. They also chop sideways. There is a good deal of unpredictability here, but there are patterns around how trends begin and how trends end. And it's especially important to understand the patterns that occur around the end of trend. If you just want to understand one, a good place to start is to start with the climax and know that pullbacks come in several different forms, and all pullbacks really are pauses in these ongoing trends, but there's a lot of rich structure here, complicated by a lot of randomness also within these pullbacks, and you now have a catalog of the different pullbacks. So that is the official end of today's session, but let's look at some current pullbacks. Here's Costco. So this is an example of a market that has been down quite a while. We've declined from over 600 to roughly 400-ish, and now we're putting in, and by the way, I've been speaking with you here, so I'm not looking at the market. I don't know with most of these what's happening, but this is an example of a trade where the way we would think about this is we would like to enter this on weakness, not necessarily to be short here, because there's definitely also the risk of mean reversion of the market snapping back when a market has made a big move. That's one of the other things that happens, one of the complications. But if we were to sell off, you would look to trigger shorts on weakness, most likely. We haven't talked much about specific entry techniques yet. Here's a pullback in First Solar. A lot of the solars have been pretty weak, and we did have some tradable bear flags. This was a recent tradable pattern in many of them, and also you can look at, there's an ETF, TAN, T-A-N, that is picking up some nice bearish patterns. But when you see here on what has been support and you're consolidating on support, what this shows you is this is a failure of price rejection. So you've come down and you've made this support and we bounced, and now we're sitting here hanging out on support. That is a very typical break of a pattern that happens before a break of support. Why might this one be less good? And by the way, the stock caught a downgrade. This is the one that I saw pre-market, and we opened down here. So here's a couple lessons here. First of all, unless you're watching that in the pre-market and somehow you were able to execute, where do you enter your short? You don't enter your short down here. No. You enter your short down here, and so this is a case where let's say you've been watching this for a couple days and you really wanted to short on weakness, and then the damn thing opens at, where did it open? I don't know, 35, whatever. You can't short that. So you have to be okay to walk away from that and say, okay, that turned out to not be a tradable pattern as much as I had hoped and wished that it would be. Got a big gap down, was not able to trade that. And the reason it might be less good is actually it's very similar to the risk here with Costco. Just whenever we've had a single big move like this, there is always the risk of mean reversion. So even though, look, resulting, okay, had you gone home, had you shorted this close, you would have had a huge winning trade on the open. And I would argue that was a stupid trade where you had a good outcome. So if you did not, if you were just evaluating, now imagine that you actually did that. Maybe some of you, maybe someone watching this is, you could actually tell me this. You could say, Adam, I just made $20,000 on this single trade. I was risking 5,000. I made 4 times my intended risk, and I was in the trade literally overnight, and I got out on the next open. That's a great trade. And if you don't understand, and you're doing your trade review, you might look at that. You might say, how can I do more of this trades? Well, you can't, because you got lucky. You did something stupid and you had a good outcome. And if you don't understand that, if we don't understand how to separate our results from evaluating our decisions, we're going to not be able to make very good evaluations. And this is one reason why so many traders who do trade review are absolutely wasting their time, and they're learning the wrong things. But in this case, this was just not a tradable pattern based on the outcome. But as of yesterday's close, what I would have thought about is, I'd like to look to short this on weakness. I hope that makes sense. It's a little bit of rambling. Here is another bear flag. This is one that is already worked out, but we, in real time, we were able to see these bearish patterns lining up, and we had 2 cruise stocks. Norwegian also showed a very similar pattern, and this was a relatively easy trade. So these are trades you can do yourself. I'm not going to go through this. I did grab yesterday's 2-minute S&P chart, but I'll just point out here, there are a number of pullbacks, there are a number of things that line up with all of the things we've talked about. You do need to be aware that sometimes events can cause a little bit of volatility in announcements, but we'll spend a little more time looking at intraday charts. We're already running just a bit long today, and I do want to get to some questions. So here are questions. If we're looking for the setup leg to be as strong as previous legs, is one of the characteristics of good pullback, does that mean you should only trade pullbacks following at least the second leg of a trend? Let me move my questions over here so I don't have to show you the side of my head while I'm reading the questions. You now know the answer to that, right? Which is you can trade in any place in the trend. There's good reason for waiting until you see a little bit of little bit of trend picking up momentum. I'm trying to figure out where to put my screen here. Figure that out. Okay. So that's why I'm not actually making words. But if you catch that move at the beginning of the trend, then it's a significantly different dynamic. And same thing with trading the tight and fast pullbacks. You have to be prepared to manage those a little bit differently. Good question. It tells me you're thinking about trend structure correctly, and it's it's a question that everybody kind of needs to answer for themselves. One valid trading plan is to be prepared to miss that first move, to only take subsequent moves. Do pullbacks always slope? No, they don't. But I'll tell you one thing to be a little bit careful of, and I think I can write on the screen here. One thing you do want to be careful of is a pullback that slopes in the direction of the trend. So let's say you have, okay, so you have a successful trade, and then you have something that kind of goes into a pullback, but it goes this way. Now, if the pullback is flat, it's fine. But what I have found, if it bleeds in the direction of the trend, as we said in the first session, where you're looking for some kind of psychological reset to overextension, This is less effective in that sense because the market's just kind of doing sort of a boring bleed in the direction of a trend. This is not particularly tradable. It also gives you, if you do see something like this and you want to put a trade on here, you're in the vulnerable place of putting a trend on when it's a little bit extended, which means you might be subject to mean reversion. That's the beauty of putting a trend on here. I'll use my words right. Putting a trade on here at B instead of A is that at B, the market has made a pullback. So you're no longer buying a market that's potentially extended. Anytime we enter a market that's extended, buying to the upside, shorting to the downside, there's the risk of that market snapping against us. So this is a vulnerable place for trade location, and it's probably a less optimal trade in many ways. Can charting patterns affect how cleanly you see and delineate patterns? Absolutely. One of the things that, Tom and I worked with a group of traders who were absolutely convinced that the lines on their screens, they were all using the same charting package, and they had grid lines in specific places, and they thought that those lines affected the market. So they traded around this, but it was all random and they lost money. So yeah, you will notice in my look, actually, this is worth pointing out. Look at this chart. Do you notice I have no horizontal grid lines? That was a decision I deliberately made many, many years ago, because if you have a line on the chart, your eye is going to tend to treat that line as significant. So a lot of things, when people tweet about significant levels, what they're actually doing is they're looking at grid lines on their charts, and it's utter silliness. So this is why I have completely removed grid lines from my charts. It's one example, but yes, the charting package, the way the data is presented to your eye, the indicators, look, you see I'm using, all my charts look the same. How boring is that, right? All my charts are the same color. Actually, I think I did color the moving average differently in some of them just to, for those screenshots, but all my charts look the same tools, same indicators, and they've looked this way. The last time I tweaked my chart setup was I added sigma spikes to many of my charts, but the Keltner channels and the MACD I was using in the mid 1990s, and that has not changed. Why? Because it presents the data to my eye and my brain in a way, and structures the market data in a way that lets me interact in a consistent manner with a pretty random market sometimes. So that's a very smart question. How do you differentiate a controlled and uncontrolled pullback by length of the pullback or by characteristic of the candle pattern? Not so much candle patterns. We haven't talked about candle patterns, and we're not going to, but the question of controlled. And there was another question. Somebody said that, I completely lost my train of thought because I was reading the other questions. Who is controlling the pullback? When I say a controlled pullback, who's controlling it? Well, it's not that anybody is controlling it. A lot of the stuff you hear out there, like people blaming things on market makers and stuff, like people don't know what they're talking about. And anybody who talks about the market makers taking their money, they just don't understand how markets work. But an example of uncontrolled is a question of volatility, and volatility tends to be lower in pullbacks. So, and this actually, look, let's talk about resulting. This is a nice pullback. So you have a market that makes a new high here, and that makes a nice controlled pullback. That's a great pullback to buy. Now it happens, it failed, right? So, this is an example of a controlled pattern. This is an example of uncontrolled because of volatility. Okay, I did. I'm hoping you can provide a few comments on why it's better to wait for a pullback instead of just going in when it looks to be trending toward a direction. Not FOMO, but when you see it going regularly in one direction. Well, and this is essentially what pullbacks are, but what you're doing is you're doing it in a disciplined way, so you're not just try it. Try your trading idea to, I'm not throwing that out there as a challenge, but I think if you do it practically, you'll start to see the difficulty with that very quickly, which is that, how much does it have to move before you're going to buy, and what expectation after you buy, and how do you manage your risk, how much you're going to let it come against you. And what the pullback does is it gives you a structure that you can work within that will put you, puts you in a position of strength, because you're not buying a market that's at its absolute high. You're able to see patterns evolving. Like, look, if I buy here where that X is, it's a difficult trade to manage, because I sort of don't really have any patterns there. I hope it goes up. If it doesn't go up, how do I know it stopped going up? I don't know when I can say the trade has decisively failed, but with a pullback, you have much clearer structure to trade against. How tightly correlated are stocks with indexes? Pretty correlated. How much can we trust to take positions ignoring the main trend? It's a question mainly of holding period and market dynamics. If you see, most of the stocks are going to move with the indexes. And if you put on 50-50 longs and shorts, if you're an individual stock trader and you always have, the same number of each, you're going to find that your win ratios are highly skewed by the outcome of the index. So if the overall market goes up, you're probably going to get kicked in the head on most of your shorts. But the shorts that will work could be shorts where the shorts where there's a really dynamic pattern, where there's some clear, and what this is really driven by is new information coming to the market. We're not trading the news, we're not trading the fundamentals, but the fundamentals will make a pattern that will show us that here's a stock. If you see a really, really great short setup, you can take a short trade, but your holding period probably needs to be relatively small. Practically, what does this mean? What's a relatively short holding period? Maybe 2 to 5 trading days. If you, even with a really powerful short setup, if you were in those patterns for a couple weeks, the index is going to start taking over, and even then you'll see this breakdown. We also are going to talk about this a little bit more in the future. So I think that is a great place to wrap up. I appreciate all of your time and focus here, and we'll see you back next Tuesday for the next session. Thank you, everybody. Also, sorry, just one thing to wrap up here. If you have questions, send us the questions, and we were looking at all these, and we'll continue to do Q&A at the end of each session, and we'll have a lot of Q&A in the very last session, which will be highly focused on that. Thanks again.